Hi, this is Dave Ford, President and Founder of the Atlantic Gold and Silver Centre. Today is Wednesday the 16th of November 2016 and today we're going to be talking about Trump, inflation and precious metals. Okay, so to understand the situation we're in today, we need to go back to 2008 and see what the effects of the crash were. First of all, a lot of people lost their jobs, their income dried up, companies downsized, and a lot of people went on to employment benefits, significantly cutting their income. Secondly, those same people would have seen the values of their houses collapse, probably 50–75%. The values absolutely plummeted. That was a main source of savings and future for a lot of people, and they saw it evaporate. Thirdly, the value of any of their investments and pensions also went right down. Now, if you were in that situation, and a lot of people were, and a lot of people still are, you would not be out spending money buying new cars and flat screen TVs in a hurry. You would be saving and storing every penny you can for the next decade to try and rebuild your balance sheet and have some savings for the future when you want to retire. Most people don't want to work until they're 70 or 80, working in fast food establishments and places like that just to make ends meet. They would like to save up for their retirement and have a comfortable retirement. So these people who were looking forward to a comfortable retirement suddenly found it all swept away. And since that time in 2008, anybody in their 30s, 40s and 50s has been saving and putting money aside to try and store something up for the future. Now, the economy hasn't looked that good for the past few years, which means that not only are they saving up for the future, they're not particularly optimistic about the future. It means that the economic outlook is affecting whether they spend money or save money. And so far, all it's done is reinforce their view that they need to save as much money as possible. The Fed has been fighting against this. They are the ones who have indulged in massive amounts of money printing to try and get people to start spending money. The idea is that if they can put enough money into the economy, people will start spending it and it will create optimism. But what happens is these people who have been saving just put all more money into savings. This is what people call the money on the sidelines. People who have been saving and putting things aside have not been prepared to spend because they've been worried about the future. Okay, so that brings us up to today. Now, what happens when those people suddenly start to feel a little more optimistic? Now, these people have money on the sidelines, and this is what the Fed has been trying to get people to spend ever since 2008 by printing trillions of dollars of money and injecting it into the economy through banks and through various other mechanisms. So once these people actually start to feel a bit optimistic, and it does happen, there are various triggers that can turn an economy around and make it feel a little bit better. Once these people start to feel a little bit more optimistic, perhaps they've saved enough for a significant portion of their future, and things start to become more positive in the economy, they start to worry less, and then they start to think to themselves, well, maybe we can afford a new car, maybe we can afford a vacation or a new TV or to do some work on the home, and they might actually start spending money. Now, the point is different for everybody, but in general, once the confidence of the economy turns a corner and starts to pick up, those people with money on the sidelines will actually start to spend. And this is what is a parallel to happened in Germany, which caused the rampant inflation there. After World War II, for war reparations, the German government could print hundreds of millions of German marks without any damage to the economy because people were just hoarding the money. At some point, though, inflation returned when the people became more confident that the economy was better and that their future was a little more secure. Then they started going out and spending the money that had been on the sidelines for so long. Now, this is what the Federal Reserve wants people to do. The problem is, and we've heard this saying before, is they've let the genie out of the bottle. Once these people start spending the money that they've had saved up and on the sidelines for years, there's no way to get it back. The Federal Reserve thinks they'll just tighten monetary policy and they'll rein in any inflation, but it won't work. The money that will come out will be out into the economy and it'll be too late. Once the money flows out into the economy, people start to see prices rising. Only a little bit at first. Groceries in the store may go from $1 for an item to maybe $1.10 a few months down the line. Then a few months later, $1.25, maybe $1.50. But suddenly people start to realize the money they've saved up is losing value because prices are rising around them, because everybody's spending money. Prices start to rise more rapidly as people decide they don't want to hold on to the cash anymore, and inflation is starting to creep in. Once this happens, you start to see a cascade effect, and the results can be very, very fast and very, very catastrophic. Inflation in places where they've experienced this kind of hyperinflation has been 100%, 1000%. The money vastly loses its value and suddenly becomes worthless. So what does this have to do with the Trump presidency? Well, once Trump got in, we saw gold and silver rally sharply and the stock markets crash down, and the Nasdaq went limit down overnight. But that soon reversed as people started to get ideas that having a successful businessman in charge of the US economy might not be a bad thing. Looks at some of the economic policies that he was announcing the following week about reducing regulation, reducing taxation, are all positive for the economy. Now, the problem is that this could be the spark that encourages the money off the sidelines for the people who've been worried about the future. If they see the economy start to turn around and optimism starts to creep back in to the US economy, we could see the situation start to develop, which I've just described. The money starts to come off the sidelines and into the economy. And even though the economy may initially be doing well, this may be the trigger that starts hyperinflation. Now, we'll have to see how long that takes, and when it happens is very difficult to tell. You'll see it first in just prices of goods and staples. In Canada, we've already seen a rise, but that's mainly due to the exchange rate and the falling exchange rate of the Canadian dollar. But keep your eye on inflation statistics in the US, and we'll soon see whether it's about to happen. So, for the short term for gold and silver, we may see things flat or even slightly depressed for a little while. Any dips would be good opportunities to buy. We could go sideways on here for a little while until people start to realize that inflation is coming, and it's coming big time. This is the situation that most gold and silver buyers have been thinking about and worried about for the last decade. That since 2008, 2010, when they started printing a lot of money, this is going to be the ultimate effect of that policy. Rampant inflation, and gold and silver will go up very, very sharply. So we're in a kind of eye of the storm situation. The economy may look like it's improving. Gold and silver prices may drift down a little or just go sideways for the next few months, just as a reaction against stocks going up. But this is the time to be really making sure that you've got some in your portfolio. So keep an eye on inflation in the US, buy at any low points in the market, and stay well read and informed about what's going on. Thanks for watching. We'll see you again in a couple of weeks. Bye.